Looking for strategies to help you protect your portfolio in these uncertain times? Visit robblack.com. robblack.com, powered by EP Wealth.
Let's take a look at the market numbers today. The Nasdaq's up 0.5%, sitting at 22,817. The Dow Jones Industrial Average 30, also up 0.5%, sitting at 47,986. The S&P 500's up 1/3%, sitting at 6819. And the Russell 2000 is up almost 1%, sitting at 2576. Gold's up 2.6%, 5236. Platinum up 3%, sitting at 2235. Silver's up double that, 6.2%, $89.82. Crude oil, I guess is probably the first one I should have done, down another 12% today, $83.36 a barrel. The VIX is calming back down. It's 2279 reading. The fear index of Wall Street showing us that the fear spiked above 30. Typically, numbers around 27, 28 is when we pay attention to the VIX as things are getting out of hand. And when you get as high as 40, it's usually deemed a buying signal off of Warren Buffett's be greedy when others are fearful angle. Bitcoin sits up $2,400 at 71,495 this morning. Individual stocks, I see Nvidia's up 385, Caterpillar up 21, up to 726. So there's big recovery in some names that have been hit recently. Meta is up $9, up 1.4%, sitting at $656. Qualcomm got a downgrade today. More on that in just a minute. This is the first time, I believe, that social media has played the part of diplomacy, if you will. A lot of tweets going out in recent days. Oil's extending yesterday's lower move following President Trump signaling into the Iran war could be near. Stocks move higher after initial resistance after the IEA announced meeting will be held later today to discuss the stockpile release. Stock market had a tough start to the week on Monday, but ultimately recovered from the early pressure as crude oil backtracked from its highest since mid-2022. Monday's intraday rebound will be put to the test today. It was a wild move in oil with a lot of tweets helping along the way. Taking a look at the crude oil, it's up 45, almost 46% for the year. Gold's up 20%, silver up 26%, Bitcoin down 21%. The Magnificent 7 as an ETF is down 5.5%. Russell 2000 small cap stocks are holding on to a somewhat of gains, up 2%. Nasdaq's down 2.3%, and the S&P 500 is down 1%. Interesting day in history. The Nasdaq Composite closed at 5,048, its record high at the peak of the dot-com bubble. It then fell 78% from that level over the next 2 years, March 10th, 2000. I lived through that. JP Morgan warns of a 10% correction if the war keeps on. The bank said the S&P 500 could slide by double digits if the Iran war rages on. Morgan Stanley took a different stance, arguing that the market's rolling correction since last fall is almost over. I'm with Morgan Stanley a little bit. The Magnificent 7 have reported great earnings, but have gone sideways as money has come out of them and into other parts of the market, creating a healthier breadth to the market. If we've learned anything about oil strikes, history repeats itself. When the missiles are flying, it's time to be a buy-in. It's dumb, it's stupid, it makes no sense. Right now, of note, oil's not being pumped in parts of the Middle East. That's worthy to think about in the coming days, as if the war marches on, we're going to worry about this again. Americans are withdrawing money from their 401ks at record rates. Vanguard said 6% of its clients took a hardship withdrawal from their 401ks last year. That's a 4.8% increase from 2024. Last night, President Donald Trump said we're achieving major strides towards completing our military objective, reinforcing earlier comments that the military campaign could soon end. Defense Secretary, or Department of War Secretary as he wants to be known, Pete Hegseth, said today will be our most intense day of strikes inside Iran. He also noted that Iran is badly losing. Meanwhile, the Speaker of Iran's parliament wrote in a post on X that the Middle Eastern country is not looking for a ceasefire. Energy ministers from the Group of Seven Nations, Canada, France, Germany, Italy, Japan, and the United Kingdom and the U.S., are meeting today to talk about releasing some of the world strategic reserve. Amin Nasser, CEO of Saudi Arabia's oil giant Aramco, said that the Iran war will have catastrophic consequences for the world's oil market. Paul Gooden, head of Global Natural Resources at 91, said oil prices could spike above $120 a barrel if the disruption of the market is extended. So I'm throwing down some of those quotes to keep you honest. Airlines are pulling back. Bernstein says it's time to buy. Bernstein analysts noted the airlines are poised to power through headwinds posed by the Iran war, including rising fuel prices and different transit conditions that are quite difficult. Another quote from Bernstein was, "It is impossible to know how long the current oil crisis will last or know with certainty how the shock will ultimately impact the broader economy." Yesterday was a wild day. Oil up, oil down. It went from apocalypse to all clear. And again, down another 10% today. Yet the Strait of Hormuz is letting vessels through, just not very many. Sunday night, when oil spiked to 120 for the first time since 2022, analysts were scrambling to set $150 price targets. But that push to 120 on oil futures didn't last long as Trump started tweeting. Short-term oil prices, which will drop rapidly when the destruction of the Iran nuclear is over. It's a small price to pay for the USA and world safety and peace. Only fools would think differently. That was one tweet. Then on Monday afternoon, President Trump told CBS, "I think the war is very complete, pretty much. They have nothing left." By Monday night, President Trump posted a warning to Iran not to stop oil flows into the Strait of Hormuz, with a pretty ominous tweet that evening about raining death, fire, and fury if anything goes bad here. Intuit was upgraded to buy from hold at Rothschild and Redbird. The TurboTax and QuickBooks owner has transcended the fears of possible software destruction from Anthropic. Stock has had a massive move. CrowdStrike got upgraded to buy from hold from Morgan Stanley. It's having a big bounce after facing heat from Anthropic on the idea that agents will be able to protect companies' cybersecurity better than software companies like CrowdStrike and Palo Alto Networks. TD Cowen downgraded Novo Nordisk to hold from buy. Novo's Wegovy pill is giving its obesity business a much-needed boost right now, but analysts say the GLP-1 pipeline is not as compelling as it needs to be. Eli Lilly is the leader. Bank of America Securities resumed coverage on Qualcomm at underperformed target of $145 due to lukewarm sales and earnings. Qualcomm is a leader in smartphone processors, but it's a mature industry with downside risks from rising memory prices. Qualcomm's well-known imminent $7 to $8 billion loss of Apple's business for modems were cited in the report. Qualcomm is diversified into auto, Internet of Things, and plans to enter AI data center, but benefits could be insufficient to offset the mobile headwinds. $145 price target is based on 13 times 2027 PEE. Upside risks are Qualcomm's entry into large but highly competitive AI data center market with an analyst event planned for first half of 2026. Goldman Sachs cut Flutter Entertainment's price target to 205 from 270 after the FanDuel parent reported disappointing fourth quarter results. Prediction markets don't seem as entertaining as FanDuel's website, but I don't know that industry well. Apple manufactured 25 million iPhones, about 25% of its global production in India last year. That's up from 36 million in 2024. That should put the iPhone maker ahead of Wall Street's schedule. At the start of 2025, analysts predicted Apple's iPhone production in India would reach about 25% of the market by 2027. You might remember Trump tariffs and China not playing well, and the United States not playing well, and Apple panicked and sent a lot of business to India to manufacture. NVIDIA announced a long-term partnership with AI startup Thinking Machines, founded by former OpenAI executive Mira Murati. The deal involves an investment from NVIDIA and a commitment to provide 1 gigabyte worth of the company's next-generation Vera Rubin processors. Thinking Machines has raised about $2 billion for a reported valuation of $50 billion. Meta has acquired Moltbook, the AI-only social network. This is getting tough to follow. There's a lot of little deals going on, and the little deals take just as much work as taking a look into the bigger deals. But Moltbook is a viral social network where humans are allowed to read, but only AI agents are allowed to post. Moltbook's founders are going to join Meta Superintelligence Lab, which is run by Alexander Wang, formerly of Scale AI. SpaceX wants a NASDAQ listing with early NASDAQ 100 access. SpaceX is leaning towards listing what's going to be potentially the biggest IPO ever on NASDAQ. That's contingent on early inclusion on the exchange NASDAQ 100 index. Typically, companies have to wait up to a year before being considered for inclusion in indexes like the S&P 500 and the NASDAQ 100. But NASDAQ wants that listing because it's going to do a lot of trading contracts. So they've proposed a change that could decrease the wait time to under a month for mega cap companies. SpaceX is looking for a staggering $1.75 trillion valuation in June. This could be, and again, I'm just trying to show you where we think that could be the thing that breaks the tech momentum. $1.7 trillion is going to pull a lot of money out of Apple, Microsoft, NVIDIA, Meta, Amazon. You get the idea. If you have 20 stocks on your scorecard and you see a brand new shiny one, you may sell some of the ones that are current because you may not have the money, cash on hand to commit per se. I have a big event coming up tomorrow night. It's a little under attended. It's going to be my last event on the East Bay, or in the East Bay. You can sign up for it. It's wealth preservation, retirement planning event. I'll get there around 5:30. Starts at 6:30. Goes to about 8:30. If you have any questions, drop me an email, rob@robblackshow.com. 6:30 to 8:30 tomorrow evening in Lafayette. Sign up at robblackshow.com. That's robblackshow.com. Take a break. We'll be right back.
These days, retirement planning is more complicated than ever. So set aside Wednesday evening, March 11th, and get ready to learn some strategies for navigating wealth in uncertain times from Stephanie Richman, Rob Black, and Nathan Rogers. This event will focus on retirement income, tax strategies, estate planning, and tax planning. If you're at or near retirement with at least $500K in investable assets, this seminar is for you. Stephanie will explain how to transition your portfolio from the accumulation phase to the income phase, which accounts to draw from first, how to protect your estate from long-term care costs, and much more. Learn how to invest during inflation and interest rate moves, Social Security strategies, and managing IRAs and 401ks in retirement. Rob Black will share market happenings and trends. That's Wednesday, March 11th, 6:30 p.m. at the Lafayette Library in Lafayette. Space is limited, so sign up today at robblackshow.com. That's robblackshow.com. Investments not FDIC insured. Past performance does not guarantee future results. Not an offer to sell or a solicitation to buy any security. Member FINRA SIPC.
We're a couple hours in at this point in time, and the market's not extending too much, but still up. The S&P 500 is up 0.33%. Looks sideways for the last hour and a half. The Dow Jones Industrial Average, same thing, up 45 basis points. The Nasdaq's getting a little bit further ahead, up 62 basis points. 100 basis points is 1%. So 0.6%. The Russell 2000 given back just a skosh, up 76 basis points. NVIDIA and GTC is coming. When you put those two together, GTC is an event that's March 16th through the 19th. You get the CEO of NVIDIA typically presenting new hardware. It's a brutal cycle how often they have to update, get things smaller, cheaper, and faster. And at some point in time, that chip premium slips. It has not yet, though. NVIDIA is expected to show multiple hardware innovations, potentially including a new chip for inference, the process of generating results from artificial intelligence models. It's hard to see NVIDIA being able to provide thesis-altering commentary that creates a breakout unless we get a little more confidence around their scalability, networking leadership, AI, CapEx durability. How's the market going to shift from adopting co-packaged optics, integrating optical engines directly alongside chips, to tackle the challenges of high-speed data transfer? NVIDIA recently invested big dollars, $2 billion, into Coherent and Lumentum. So GTC is next Monday, but you're already starting to see some announcements. Today, NVIDIA announced some money being thrown into AI startup thinking machines to deploy at least 1 gigawatt of next-generation Vera Rubin hardware. Again, a very circular deal. We invest in you, you give us shares, you buy our chips. Dave & Buster's is doing something interesting. They're offering 60 days of unlimited gameplay with a new pass. It's looking to capitalize on daylight savings time with that new guest pass. 60 days of unlimited play for an upfront $60 cost. The pass offers 60 days of consecutive visits and unlimited gameplay. If you throw your entertainment dollar into things like Dave & Buster's, sounds like a pretty good deal. I personally don't like the lights flashing, the jackpots ringing, the tickets flying. I don't like going because the food's not terribly good. I'm a bit of a food snob, but my kids, when we go, we haven't been in a year or two, but holy mackerel, do they get excited. Analysts are looking towards the next play for the oil markets. We've had a big dislocation. Oil continues to whipsaw, tied towards headlines and tweets. Right now, Trump is saying it's very much complete. Oil prices are down 25% from the eye-popping nearly $120 a barrel they touched Sunday night around 6 p.m. my time. Still above $80, which is starting to be the area that oil becomes problematic for the United States. It becomes recession quality problematic around $120 to $130 a barrel. But oil around $85 a barrel would sap a lot of Trump's one big beautiful bill, largely the tax refunds going to individuals. It would sap a lot of that. The positive energy, the big cash outlays to individuals. Now they're putting big cash outlays into gasoline. Gasoline prices aren't cheap. They don't tend to come down nearly as fast as the price of oil. We still don't have oil being pumped out of the ground in most parts of the Middle East. California gasoline's around $5.20 a gallon. It could approach $6 this weekend. It's about $1.70 higher than the typical average of the United States at $3.45 because of higher taxes, environmental fuel rules, and tighter refining capacity. There's some places that gas touched $8 a gallon. And it's time to fire up the Tesla or the electric vehicle when that happens. Hottest job in America right now is electrician. It's not just a construction worker, but data center electricians are making $130 an hour. The average electrician gets about $30 an hour. To build the AI data centers, we need 300,000 new electricians, projected to be necessary to complete the data center build-outs over the next decade. I'm a product guy. Just around 2.5 million Xbox Series X and S units were sold in 2025. Xbox has had a long flop era since 2005, 20 years. The Xbox 360 was the last time that Xbox and Microsoft had a hot product. 85 million units in its lifetime. To give you an idea of the Xbox versus PlayStation, PlayStation sold 17.4 million units last year. The Xbox just 2.5 million. In half a year, the Nintendo Switch 2 sold over 15 million. Generation Z has a big risk appetite. I don't like this. They were presented with a quote, "I invest or may invest in high risk or speculative investments because I feel financially behind." And the area that saw the biggest risk takers was Generation Z. About 80%. Being financially behind is fueling moves into higher risk and speculative assets as a way to catch up. Prediction bets, crypto. I'm looking at you. Millennials, they're about 75% on taking bigger risks. My Generation X, about 65%. Then you get to the boomers, they're just not that risk-takey. About 50% will take more risk than they should if they feel financially behind. Kohl's is jumping. Their earnings report showed cost discipline, so Sephora momentum driving earnings per share beat, offsetting some cautious outlook. Kohl's is trading sharply higher after the department store retailer delivered a strong earnings beat in the quarter. Even though revenue came in slightly below expectations, the upside earnings per share surprise, combined with cautious sentiment heading into the release, sparked a relief rally today. If you take a look at their results, they point to improving operational discipline despite ongoing sales pressure. Comparable sales remain negative due to softer store traffic and seasonal merchandise missteps. Strong inventory control and expense management drove margin expansion and a sizable earnings beat. Kohl's has a value proposition through expanded proprietary brands, improved promotions, and deeper inventory and core basics to ensure better in-stock levels. The Sephora partnership continues to support traffic and category growth in beauty and accessories. When I did TV live in studio, which I gave up on during COVID, and happy I did because that consumed about 3 hours of my day driving. It was great because I got to listen to a lot of media, but it was bad because it took 3 hours out of my day. But when I was going into the studio, the lights are so bright in television, you have to wear pancake makeup almost to try to look normal. I did not like that time of my life. But why am I telling you? Oh, Sephora. Had to go to Sephora quite often. Casey's General Store added big earnings per share beat as inside strength fuels stronger outlook. Casey's General, I talked about on the afternoon podcast yesterday. It's an odd retail play because it's a gasoline store that sells a lot of food. And they're opening a lot of stores. Prepared food and dispensed beverages led the way with same-store sales up 4.3%. Grocery and general merchandise accelerated to 4%. Gross margins improved 130 basis points, 1.3% to 42.2%. Prepared food and dispensed beverage margin was up to 58.3%. They addressed volatile fuel prices, saying it typically does not see demand destruction until prices approach $5 a gallon, with prices currently around $3 across its footprint. Casey's General Store added that the fuel margins can be compressed early in the cycle, but typically expand in the back end. But another pretty good quarter. They sell a ton of pizzas. I've heard they're good. I've never actually seen a Casey's General Store. If anyone wants to drop me feedback, rob@robblackshow.com. I might find that entertaining, to say the least. One thing I want people to get out of the recent Iran war, strike, situation, whatever we're calling it, is don't panic. A weak jobs report and the war in Iran sent stocks sliding last week. A queasy-making move for retirees is to sell. I know if you're living off your portfolios, you got some angles. I'm setting my portfolio up for high income off dividends so that I don't have to sell the underlying stock. I'm doing a lot of dividend aristocrats. Geopolitical events always make people uneasy because there's so much uncertainty. You definitely don't want to do anything drastic like shift your money to cash. That's a far cry from being in a bear market at this point in time. It's really important to have 2 to 3 years of cash in a cash equivalent in retirement so that you don't have to panic when the markets get hit, so that you don't upset your sequence of returns. It's something we'll talk about at the event tomorrow night. For the average typical retiree, it's a mistake to try to chase either a hot hand in the stock market or a market that's down aggressively. Now, keep in mind, even at its worst, we were down 2% from about all-time highs. Do I predict the war's over? I don't know. You don't know. Are there some bargain stocks out there that might make it in my income portfolio? Absolutely. I like big dislocations of stocks that pay dividends. I like big dislocation of stocks that have a total addressable market of over 100 million people. I like big markets. One thing I will say is I do think NVIDIA trades higher into GTC, but please don't forget it's got a $4.5 trillion market cap and a lot of retail investors inside of it. I'd be cautious on that because it's way easier to grow from 500 billion to 1 trillion, 1 trillion to 2 trillion. Then you start getting these just big numbers. Now, again, I think we're still early in the AI trade. Not early, but I don't think it's about to wrap up. And some of the things I see going wrong with the AI trade, like I said earlier, would be things like the SpaceX IPO, which is going to be big and shiny, $1.7 trillion. And consumers are going to want to own it. They saw what they didn't own when Tesla was a publicly traded company. But you got Tesla when it was a small company. It wasn't 1.7 trillion. I will probably be a buyer of SpaceX after a massive dip from its IPO when the insiders are selling, because everyone who's bought into SpaceX have been insiders at this point in time. It's not public. They're going to want to cash out and put their money elsewhere. Maybe into a boat, maybe into a car, maybe into a divorce, maybe I don't know. There'll be something they want to buy. A little bit of shocking news today. And man, when I see stories like this, it's cringy. Boeing faces a first quarter delivery slowdown after discovering 737 wiring issues. What? You don't want to hear the plane that you're about to take this weekend has wiring issues. They're going to delay some 737 MAX deliveries after discovering scratches on wiring within the planes. According to the plane maker, fixing the issues could take a matter of days for each plane. This could impact March and first quarter delivery figures. Boeing doesn't know how big of a problem it's going to be on an annual basis at this point in time. They're producing 42 737 MAX planes per month. Boeing delivered 51 commercial planes in February, its highest totals for the month since 2018. The figure far exceeds the 35 deliveries that Airbus, which is the European rival. There's not many companies that compete with Boeing and Airbus. That's about it. Then you get into much smaller players, obviously. Netflix has recovered almost all the way back to where it was when it put a bid in on Warner Brothers Discovery. Could have got this 2 weeks ago for $80 a share. Now it's $97. It's pretty obvious to me that the Trump administration wanted David Ellison, owner of Paramount Skydance, to win the deal for Warner Brothers Discovery, because Larry Ellison's a big Republican donor. I know you're saying, are you suggesting that this administration is crafting law to play out for the best for their own? Yes. Yes, I am. I was happy that Netflix didn't get the deal. I think it would have been not a deal breaker, but movies are tough. And just to give you an idea of how tough movies have become, Pixar just released a film that did really well at the movie theater this weekend. The tune of Hoppers pulled in $46 million domestically, $88 million internationally. But since 2018, it's underperformed when they lost John Lasseter. I think he was doing some hanky-panky or something bad. But he was the guy behind Toy Story and Monsters and all the big movies out of Pixar, which they had an amazing run from the mid-1990s to 2018. But when he left, Pixar started to underperform. Luca and Turning Red, they missed out on theatrical releases due to the pandemic. In 2022, Lightyear failed at the box office. The following year, Elemental eked out a small profit. Elio became the company's biggest flop last year. Toy Story 5 is going to arrive in theaters in June. Hoppers got great reviews, fantastic reviews. They don't really have any competition until April. when Super Mario Brothers movie comes out. It's a movie about a girl who puts her mind into an animatronic beaver. There's dirty jokes that you could insert there if you really wanted to, but I won't. There's currently no sequels to Hoppers in the Hopper, but you have to imagine they're thinking that way. 3/4 of conflicts since World War II ended with stocks in the green a year later. So the recent market reaction makes sense on paper. What strikes me is investors' conviction. It doesn't much change. Some people just stay invested throughout. Some people have cash on the sidelines that they throw in. The big question right now is how destabilized will Iran become? Or will this war basically cap itself after gas prices in the United States hit $4 a gallon, maybe $5 a gallon in California? It's already at. Polymarket was pricing a nuclear event this year at 24%. That's wild. A 1 in 4 chance of a nuclear event. Trump built his political brand on saying Iraq and Afghanistan were mistakes. It's a mistake to assume that Iran's going to go smoothly. Donald Rumsfeld, the former Secretary of Defense, said Iraq wouldn't last 6 months. It lasted 8 years, $3 trillion plus. I have an event tomorrow night, March 11th, 6:30 to 8:30 in Lafayette. Beyond the Noise, Navigating Wealth in Uncertain Times. You have to register online. It's a free in-person event to better understand today's markets and help you feel better prepared for the next moves. Stephanie Richman, Nathan Rogers, and myself are all going to present. I get there early. I talk about stocks I'm buying. We'll clearly talk about Iran. But bigger than that, tax efficiency, hedging strategies when you retire, ways to get a proper income portfolio, and much, much more. You can sign up for the event at robblackshow.com. It's robblackshow.com. Coming up, I'm going to talk with Nathan Rogers, who will be presenting tomorrow evening in Lafayette. Sign up at robblackshow.com. Don't forget about my afternoon show as well, coming up in a few hours after the market closes.
Retirement planning is more complicated than ever, and it can be hard to even know where to begin. So set aside March 11th, Wednesday evening, 6:30 p.m., and get ready to learn some strategies from Stephanie Richman, Rob Black, and Nathan Rogers that can help you retire better and pass on your estate while navigating wealth in uncertain times. That's March 11th at the Lafayette Library in Lafayette. The event runs from 6:30 to 8:30 and will focus on retirement income, tax strategies, estate planning, and tax planning. If you're nearing or you're now in retirement and have at least $500,000 in investable assets, this seminar is for you. Stephanie will explain how to transition your portfolio from the accumulation phase to the income phase, which accounts to draw from first, how to protect your estate from long-term care costs, and much more. Learn how to invest during inflation and interest rate moves. Also, Social Security strategies and managing IRAs and 401ks in retirement. Rob Black will share market happenings and trends. Navigating wealth in uncertain times is appropriate for individuals with at least $500,000 and either in or heading to retirement. Wednesday, March 11th, 6:30 to 8:30 at the Lafayette Library in Lafayette. Sign up for the event at robblackshow.com.
Joining me now, Nathan Rogers. He's with EP Wealth. He's a JD, MLS, and CMT. He works with the financial planning division of EP Wealth. He'll be at the event coming up March 11th, 6:30 to 8:30 in Lafayette. You need to sign up for the event at robblackshow.com. So let's do it, Nathan. Volatile markets have arrived after 2019, 2020, 2021. Up years, big up years. And then 22, not so much, but then 23, 24, and 2025, big up years. It was easy to make money. It was easy to create wealth, or maybe an easier environment. What do you think about market volatility? Let's start with that big picture concept right there. And what do we need to know?
Absolutely, Rob. Thank you for having me. So when it comes to volatility, it's the thing that everyone fears. We spend a lot of time, especially in years like 23, 24, 25, you just mentioned, avoiding it and not really feeling like it's there. And then it hits hard and sudden. And if we don't have a plan, we're suddenly caught unawares. And dealing with a portfolio that's probably a lot more volatile than what our risk tolerance can really stand. So the key to volatility from a financial planning point of view is allocation. Okay. And if you get the allocation right to begin with, if the allocation is driven by those risk factors, your ability to tolerate risk, the horizon that you have as far as how much time between now and when you need that money, then the allocation becomes the driver instead of the volatility becoming the driver. And in summary, what that really means is if you get your portfolio right before the volatility hits, then you're not freaking out in the midst of the volatility, because that's what tends to happen is people don't fear it till it hits, and then they're running in fear. The two primary drivers of the market are greed and fear. We want to take those out of the equation by getting an allocation that's built for your risk tolerance and time horizon.
My wife will tell you, if you ever meet her, Nathan, that I have no emotions. So I'm perfect for the stock market. I'm not greedy and or fearful. I'm not loving. I'm not sweet. I'm none of those things. With that said, you gave me some notes, and I really liked one sentence or one line. You said, have a written plan for withdrawals, opportunistic investments, and tax-aware rebalancing, avoid emotional trading. The opportunistic investments, I like that idea because to me, when the markets get volatile, that's when opportunity knocks. And I see when the VIX hits 27, 28, 29 or higher, there's some dislocations there where most people with emotions get fearful because they're losing quote unquote wealth, but it's paper wealth. Mm-hmm. I see opportunity. Do you want to address that idea of opportunistic investments?
Yes, absolutely. This is something we don't always talk about enough. I know you talk about it, Rob. In my world, we don't always talk about this. And it's such a key point, which is that one of the relevant pieces of why we have cash as part of an allocation isn't just the fact that we're going to need to spend that money. It's dry powder. It's something available that you have that is a pre-anticipated allocation for opportunity when it strikes. Many people think of the stock market as risky, and that can be true. But the issue is, first of all, what's your time horizon? It's made far less risky by a long time horizon. And second of all, when are you investing? And that doesn't mean we're ever going to be market timers. I just got finished saying asset allocation is where it's at. That's how you factor for risk. But if you're willing to build a part of your allocation that is a cash balance that is not only the cash you need, but some opportunistic cash, what it allows you to do is place additional investment into markets. And this doesn't have to only be the stock market. We'll focus on that for this minute. But it means that when volatility strikes, you have some cash available that you can actually put in and make a dollar cost averaged investment when risk is much lower. Because if you think about it, the market is, its risk is oscillating. It's not a constant state of risk. And a market that has dropped precipitously, or at least significantly, is actually a less risky market to enter from a historic standpoint than a market that's been on fire for 3 years. And so part of that is keeping some cash available for that purpose. It's not strictly for the stock market. There's other things we can do too, but that's one piece of that opportunistic pie.
So let's wrap this with one final thought. I'm going to give you the softball. Protecting your portfolios in volatile markets, I get it. People get fearful. People get greedy. They sell at the wrong time. There's the sequence of returns problem that you don't want to have bad years early on in retirement, and you have to have an emergency fund. I'm over talking. What do we need to know about protecting portfolios in volatile markets?
We need to know that it is not first of all, it's not a one size fits all. Not everybody is going to do it exactly equally. But what it should look like is a function of what you can tolerate, combined with intentional ways to reduce volatility. And reducing volatility intentionally, that's where your fixed income piece comes in, but that's also where your private market allocation pieces come in. So if you're building a little construct, maybe a 5 to 10% piece that is a private credit part of your allocation, and another little construct of perhaps a private real estate piece that's another 5 or 10% piece, are historically significantly less than the rest of it. With a 10% private credit piece, a 10% private real estate piece, your fixed income allocation. When volatility hits, your drawdown is going to be far less significant than somebody who's invested either entirely in equities or even in equities and fixed income only portfolio. And now you're starting from a better place as the market gets going again. So in other words, if your drawdown is 10% compared to a market drawdown of 15%, your starting point is now 5 or 10% higher. And that means you have less ground to make up in that volatility. It really comes back to the first thing we started on. It's why allocation it's almost everything when it comes to volatility. It's building your allocation right, because then that allocation drives instead of volatility and emotions driving.
I'm really looking forward to listening to your presentation coming up on the 11th. That's this week, Wednesday, 6:30 to 8:30 in Lafayette. People need to sign up at robblackshow.com. The reason I'm really looking forward to this is you just talked about like concentrated positions. And I came into the retirement era time frame with a lot of tech stocks and a lot of growth stocks. You can find me online at robblackshow.com. Don't forget that event's coming up this week, Wednesday, 6:30 to 8:30. Sign up at robblackshow.com.
These days, retirement planning is more complicated than ever. So set aside Wednesday evening, March 11th, and get ready to learn some strategies for navigating wealth in uncertain times from Stephanie Richman, Rob Black, and Nathan Rogers. This event will focus on retirement income, tax strategies, estate planning, and tax planning. If you're at or near retirement with at least $500K in investable assets, this seminar is for you. Stephanie will explain how to transition your portfolio from the accumulation phase to the income phase, which accounts to draw from first, how to protect your estate from long-term care costs, and much more. Learn how to invest during inflation and interest rate moves, Social Security strategies, and managing IRAs and 401ks in retirement. Rob Black will share market happenings and trends. That's Wednesday, March 11th, 6:30 p.m. at the Lafayette Library in Lafayette. Space is limited, so sign up today at robblackshow.com. That's robblackshow.com. Investments not FDIC insured. Past performance does not guarantee future results. Not an offer to sell or a solicitation to buy any security. Member FINRA SIPC.